So, yeah, that's not where I want to be. Crazy bright like that. So we should definitely finish this. We should also finish the planning, but we'll see. But tonight so first I'm going to start with is the Anthony video. And some of you have probably already seen this one. If you had me before, if you had me for accounting 211, you've already seen this, but it's a good one and it's good. It's for this class and it's actually more geared towards this class than any of the other ones. So there is a handout that goes with it. Yeah, hopefully you guys got that. So there's the handout that goes with it. So anyway, um, yeah. So Anthony, is actually my brother-in-law, and he was actually a really good soccer player in college. And, I think he got drafted. I don't think he ever actually went to it. I don't know who drafted, but anyway, um, he uh, he was a journalism major, and there's not too many journalism jobs out there. So when he got out, he started working for Aldi's, and this is kind of his story. And he kind of moved up through Aldi's for a while, and then he got this really big job offer. And this is kind of how that job offer kind of went. It's a fraud. It's a very interesting fraud case. And it was sort of It was sort of ironic, I think, that Anthony. Here's this guy I've never heard swear or anything, and he got caught up in this fraud. And the question is like, how does this happen? Whenever you see something like this, you go, well, how did that happen? What? And for me, the interesting thing is, there's always going to be, you know, people who are prone to do stuff like that. We all have a cousin or something that does wacky stuff, and you hear about it, you go, oh yeah, that makes yeah, I'm not surprised by that. But first of all, Anthony's not like that. But second of all, you wonder, okay, how come I can understand if one person does it, maybe two get together, whatever. How do you get like sometimes dozens of people together to do these things? How does that happen? How do you get dozens of people? I mean, it just statistically it's impossible. If whatever 1% of the population is prone to do something like that, to get 30 of them or something all at the same time at the same place is statistically impossible. And yet stuff like this happens. So the question is, how does it happen, and why does it happen? So anyway, so I'll go ahead and get started on that. Let me see if I can pull this thing up. The video, by the way, the video is really old and lousy. It goes way back to it's almost 20 years ago, and the cameras were not what they are now. And anyway, it's been re-edited several times. The original video was close to 2 hours long, or he actually talked for about 3 hours, but about 2 hours was the video the first time around, and then so now it's down to about 28 minutes, I think. But anyway, so you're going to see some lousy editing, and the video is not great. It's not you know, it looks like a 20-year-old video, is what it looks like. And let me pause this for a second and share my screen. Okay. And let me know if you can hear this or not.
I was answering an ad in a newspaper after I graduated from college, and started off as low as you can start. They had probably 2,000 stores worldwide at that time, but just a few here in the U.S. They had just started. Started out as an assistant manager, became a manager, a district supervisor.
Can you guys hear this?
Fast. They needed young, energetic people.
Yes.
And ended
Okay.
up in their purchasing department.
Sorry about that.
Which was a great, steady position, corporate level position. Didn't have to move around, and was responsible for negotiating. At the end of my 16 years there, it was over $1 billion of merchandise a year, and I was one of many people there. It was a very large organization, which has only grown since I left. But it was privately held, and that's the key to one of the things I wanted to talk about today. I had my whole corporate experience in a privately held company. One family owned it. It's a company that managed its expenses very wisely, never spent an extra penny on anything they shouldn't be spending a penny on, and they bought product correctly. You could negotiate in good faith with vendors, They knew that what you agreed to verbally was going to happen, and very importantly, at the end of the day, that their invoices were going to be paid on time. If you agreed to pay $1 for a bottle of vegetable oil, that's what you would get paid. You would always get paid on time. Aldi is a company that has operated that way and grown and been incredibly profitable doing that. The business model is very simple. Buy low, sell it at a fair price, hopefully lower than everybody else, and make your thin margin in the middle and grow off of that.
Decided that maybe you would leave there?
That's a very good question. One thing about Aldi is that they are so structured. There's a very clear corporate ladder that you climb. As an assistant manager in a store, you become a manager, then you become a district supervisor of 5 stores, and then you hit this director level. I had progressed through the first 3 up to the director level in about 5 years, which was about normal in those days as they were growing fast. Once I became a director of purchasing, I did that for 12 years, or 11 years, let's say. And the vice president that was over my department was the same age I was. There really wasn't much room for advancement for me at that point. So I could comfortably be a director for the rest of my life, always do the same thing I always did. You know, in my late 30s, thinking if I'm ever going to make a change, you know, that was the time. Got contacted out of the blue by a recruiter for Fleming, and they were serious. And the numbers they talked about were, you know, they asked me what it would take, is what it got down to. So I could negotiate a salary that was very comparable to what I had, and one thing that I had never experienced. I mean, they were a publicly traded company. They offered me these things called stock options, and that was an incentive as well. Fleming stock was trading at about $11 a share at that time, and had good prospects to go up. And you know, here I was, somebody that had worked in a publicly traded environment, very close knit, didn't talk to a lot of other retailers, and there was a real player out there, probably a Fortune 100 company at the time, billions of dollars in sales, easily 4 or 5 times the size of company that Aldi was, and they were serious. They had the right package, and also something that I had never experienced was a bonus. You know, they would match his salary and offer a bonus. I was actually hired away to start a chain of stores very similar to Aldi. Originally, the purchasing office for this new chain of stores was going to be here in the Chicago area, so I got to stay here. When I originally negotiated it didn't involve a move. I knew it could happen, but they allowed me the freedom to set up the corporate buying office for this little chain of stores anywhere we wanted. And fortunately, one of the executives responsible for this program at Fleming lived in the Chicago area. He wanted to stay also, so we set up an office in Northbrook, and I worked out of that office for a little over a year before it closed. It was a cost-cutting measure to close that and take all of the purchasing into their corporate office in Texas. And it was something that I always knew might happen, and it made sense. Fleming had actually moved its entire company, and this is significant later when you find out why people inside a large organization do what they do. Everybody from Fleming moved from the previous corporate headquarters in Oklahoma City to Louisville, Texas. The whole company moved. They leased a huge warehouse space. It was like an industrial park, and it became the corporate office for Fleming. But everybody working for Fleming in 2001, 2002, until they went bankrupt in 2003, were located in Louisville, Texas, and nobody was there originally. That's significant when you think of the pressure on people to produce numbers and why there were accounting lapses in the end that led to the downfall. The first meeting I had with Mark Hansen, and talk about why you would make a change, going from a little privately traded company, getting flown on a corporate jet down to have dinner with the CEO, and he's got this vision for a new store. And I asked him how he was going to fund this. I knew Fleming had a lot of debt, over $1 billion in debt, even though they were a large company. I said, how are you going to finance these new stores? He said, well, we've got $450 million in free cash flow. There's plenty of cash out there to open stores. I was very naive. I should have understood that anybody that's dipping into their free cash flow to fund new projects, not the best place to find the money. But there was a lot of money out there. We did get 17 stores open, and again, they were going along well enough that they thought I my services were better used managing all of the private label procurement for Fleming. The reason for that is that they said, well, how are these guys with 17 stores buying a lot of items for a lower cost than what Fleming, this $15 billion wholesaler, is buying for? How can this little group get lower cost than the large group? And it's all comes down to that culture and business practices. I had learned at Aldi that you make your deal, you negotiate for the lowest everyday price you can. There's no funny money involved with that negotiation. Just get down to the lowest everyday cost you can. At Fleming, everything was funny money. You'd have an elevated list cost that you were charged for something. There would be all sorts of allowances that were negotiated below that list cost, and that's where they got in trouble. This gap between what the list cost was and what the true cost was and what it needed to be. It took a lot of energy for the buyers to negotiate that. It was a whole different mindset for them. So they said, look, the guys that are running Yes Less know how to handle private label. We're going to let them be vice presidents of private label for all of Fleming, and they'll buy for the whole wholesaler. So when I went down there, that's what my new position was, as vice president of private label. It was 2 weeks until as I'm sitting in meetings, these guys were not good business people. That gap between a list cost and what you actually pay got exaggerated, and these guys were masters at manipulating that so that a company could report earnings when it bought product instead of when it sold product. And that really is what led to Fleming's downfall. Here's the Wall Street Journal article from September 5th. This is the last time I had something up. September 5th, 2002. It explains exactly what was going on with the vendors. It's a very accurate article because the main source was another vice president that worked several offices down from me. He left the company. He couldn't stomach it any longer. And he had an axe to grind, and a friend at the Wall Street Journal. And the information's 100% accurate. I have a lot of respect for the Wall Street Journal. It was a front page article, and it was 100% correct. The folks at Fleming and the culture there was that if you needed money to hit your earnings, you could always go back and deduct from the vendors. That was the mindset. Make a deduction. And from an accounting side, we had a controller in our group, and he would always sit there and shake his head and say, no, we can't do this, we can't do this. And somehow at the end of the day, you finally rework the language until it gets done and it gets booked. It's a few months after I got down there, Fleming signed up their biggest retail group ever. It was Kmart. Fleming supplied them all of the groceries and consumables in their stores, which is paper products, health and beauty care, soaps, detergents, things like that. A significant piece of business, about $3.5 billion as I recall. We negotiated for it. Had an internal project that nobody could talk about. They called it Project Blue, which everybody figured out as soon as you said the name from the old blue light specials. But they negotiated for that business, gave Kmart an incredible deal to supply them with all of those grocery products and consumables. My goal in that private label piece was now to make a program work with suppliers that could supply Kmart, could supply Fleming, and could supply the Fleming-owned retail group. All three, and the Fleming private label group. So we had to make everybody happy. Ice cream was a big deal. Ice cream is the largest frozen category. There's more dollar sales in ice cream than anything else in the frozen case at your grocery store. Well, our private label program was a mishmash. We had suppliers in different parts of the country, different labels all over the place. We needed to organize it, go to one supplier who could handle the business everywhere, negotiate the best deal, and make it work for everybody. What happened was Kemp's Marigold had the plant. They have enough plants in different spots in the nation they could supply everybody. They had great quality product, and they had a competitive cost. So we negotiated the deal. They also had incentive money. They had $3 million. They gave Kmart $1 million to make the change. You have to say no to your other suppliers and buy from them. They gave Fleming Retail Group $1 million because now Kemp's/Marigold is the supplier for the Fleming Retail Group. And they gave $1 million to Fleming Corporate for their private label group. So we had $3 million out there. Now what happened was in the fourth quarter of 2002, our CEO was out there talking to Wall Street saying, here's what our earnings are going to be, 56 cents a share or whatever. That's a rough number. This is what we're going to earn this quarter. And he trots back into his executive suite and gets a handful of guys around him and says, now, look at our plan. What are we really going to earn? And they find it's maybe 20 cents a share. So there's a gap. How do you make up 30 cents a share, you know, in a very short period of time and hit the projection that you've given Wall Street? You know, if you don't hit it, that your stock's going to tank, and the people will lose confidence in your company. You know, your credit can be downgraded. There's all sorts of negative things that happen when you don't hit your numbers. You know, my response was always, well, let's be more careful with the numbers we give everybody. Nobody wanted to hear that. Our CEO was trying to turn this value company into a growth company, and he sent very aggressive numbers to Wall Street. So we had a gap. And what happens is Phil Murphy would come back from that meeting and say, okay, here's our part of what we have to fill. We need $30 million. Our group had to generate $30 million. So he goes, okay, there's about 12 of us in roles comparable to mine. What are all the deals you've got out there? And one of them that I put up on the list was, I said, well, we have this $3 million from Kemp's Marigold. It's a deal we've been working on for almost a year. The money's right here. I mean, it's cash. I mean, the money's there. But the question is, how do you account for that? If that's an incentive for a program that's happening now and in the future, how do you book that as income? And can you? The answer I was told 3 times was no. You can't book it as income. You have to take it as future earnings because it's for a program going forward. So Phil Murphy said, well, call it a rebate. Call it a rebate for business we've done best. We did a little business with Kemp's Marigold already. Not everywhere, but we had done some business with them. He said, just call it a rebate and have them sign a paper telling you it's a rebate. I'm like, well, that hasn't come up before. I don't know if that's right to do that. So I talked to the sales guy that I dealt with. Is this something we can do? His CFO got back to him and said, no, we really shouldn't do that. And after going back and forth, Phil Murphy desperately needing that money because he's got to walk back into the CEO and say, we've got you covered. We've got $30 million here that we can book as income and hit your earnings number. And at the end of the day, after going back and forth 3 or 4 times with our CFO, whose name is also on that, who is it, Shapiro? Mark Shapiro? Is he on top there?
Yeah.
Yeah, Mark Shapiro was the chief financial officer. At the end of the day, I couldn't get it done. I said, look, everybody's telling me no. And I went to Phil and said, no, Phil, they're saying it can't be done. The money's there, but we can't book it now. So I'm done. And he said, just tell Shapiro to talk to Miracles about it. I said, well, okay. I said, they know something I don't find. So I had Mark Shapiro talk to Kemp's Marigold, their chief financial officer. The next thing I know, there's a letter in front of me signed by the CEO of Kemp's Marigold stating that this was some sort of rebate or something. And at the same time, their sales guy signed the agreement, the formal agreement, contract, that they were going to be our private label supplier. So, okay. I guess they knew something I didn't. Again, I was a year and a half, maybe 2 years out of working for a publicly traded company and never had to get involved with anything like that before. We'd always just negotiated and moved forward. And there was never any incentive money associated with any of the deals I had done before, but now there was. And this is the way they did business. I mean, this was normal, and it still goes on today. Super Value is the major wholesaler that does business this way, and CNS Wholesale, there are others. You know, I don't mean, I'm sure most of what they do is above board, but there is potential for danger. I signed that agreement, and we booked that money, and they hit their earnings that year. And the sad part of it is those earnings are also linked to the incentive. I mean, the bonuses that all the executives got were only available if you hit a certain earnings number. So again, more incentive for people in a big organization to do whatever it takes to hit the number.
And your options also.
And options as well, I mean, because that's all linked to the stock price. So the factors that make it so tough, it's really like a boiler room. at some point. And really, when Phil Murphy came down, he got the 12 people that controlled all the negotiations and locked us in a room a quarter the size of this one and said, we can't go out till we figure out how we're going to generate $30 million. I shouldn't say he locked it, but clearly if you left the room, you left your job. And after having just relocated your family, and again, everybody in the room had relocated their families to this area because the whole company had moved. He's obviously got to find his craft. I really feel sorry for the guy named Adams. You can read about him in the article. He was under enormous pressure because of the volume of business that they did with Fleming. Fleming was a very important customer to Kraft, $1 billion in sales. And if it meant signing a letter that $7 million or $10 million would get funneled to Fleming somehow over a couple of years, he signed it. There was still hope. I mean, when Kmart business came on, if everything happened the way the CEO wanted, it could have worked. I mean, look at what Sears did with Kmart. That worked when they just got together and made it work. But for us, it didn't. It just did not work. I could see it going bad. I was tired of being the company was using my credibility that I had worked hard for over 16 years with Aldi and doing clean business. They spent my credibility dealing with vendors now, where I would sit with somebody face to face at a desk and I couldn't tell them that everything was going to be handled. I couldn't tell them that their bills were going to be paid and that those deductions were going to be repaid. My word didn't mean anything to them anymore, and I wouldn't. I would just tell them, I said, look, we're all in trouble. This is not going to work. If you want to get those paid back, I don't think you're going to. What happens then is if they still want to do business, and that's a big if, it'll be at a higher cost. Whatever you're taking from them, they're going to add back to the top line cost because they have to make money at the end of the day. And it's a really vicious cycle that elevates the cost, makes Fleming uncompetitive in the marketplace, and at the end of the day, that $450 million in cash flow that Mark Hansen was so proud of, it went away because these vendors said, we can't handle the deductions anymore, it's not working, we have to put you on cash in advance. And that's a death note for a company. As soon as you start having to pay for product before you receive it, your whole cash flow goes away. One of the yellow flags that went up early for me, when I was running those 17 stores at Yes Less, the invoices went through the Fleming accounting system. They had a computer program that figured out how long they could stretch each vendor. I had no idea. Couldn't believe it. And it was really based on feedback. Well, how many days is it before this vendor will call me and ask for his money? Okay, it's due in 30 days, but I haven't paid in 45. When do I get that call from them? And they recorded it. Each time they would record. Okay, so this person doesn't care until 45 days. So they would just never pay until 45 days. If you weren't sitting on top of them, things wouldn't get paid. So yeah, they definitely stretched that as far as they could. But you think about that, a $15 billion company, that's $41 million a day in business that you're doing. And that's literally what crushed them in the end. When you can't buy products because you need cash in advance and your customers are clamoring for it, you're out of business. And Fleming literally went out of business because of that.
Yeah, so they could have been profitable.
Absolutely, and they were for many years. I mean, Fleming's was a 100-year-old company that had grown through acquisition and been successful up until that lawsuit with David's, quite frankly. I mean, they hadn't made money for a few years, but when Hansen was there, they reported their first quarterly profit in 4 or 5 years. And yes, they could have made money the right way. But his vision was to not just have a value stock, not just to be one that languished out there and just was kind of safe and comfortable. He wanted growth. He had come from PetSmart, Sam's, fast-growing companies, and as we looked at his history, he kind of did this at those companies too, unfortunately. And he never learned his lesson. I think he's learned it now. Mm-hmm. I was very surprised. I was surprised that people beyond Jim Thatcher, Al Abood, and Phil Murphy weren't charged. I will say that Al Abood, who was right next to me and another vice president, the whole reason he was there was because he was better at taking that money than anybody I ever met. He actually worked for Kmart, did it there, got in trouble at Kmart too, And I was astonished one day when I came in and he was in the office next to me. I'm like, Al, why are you here? Well, Phil Murphy had hired him. He apparently did such a good job taking money at Kmart that Phil wanted him on our team. And that was another red flag for me to get out of there as quick as I could. Yeah, I wish I would have stood up on the CEO's desk and said, look, this is not right. It's not right what you're doing to your own people, number one, putting me in the position where I have to, again, spend my credibility to try to save face with vendors. And for the vendors who are our partners in business, we can't be in business without them, for sure. We're destroying those relationships, and it's not right. I can give you one specific example. You'll notice one of the companies that got fined there is Kemp's Marigold, a dairy. They got fined, the CEO got fined, their chief financial officer got fined. Personally, they got fined, as well as the company, hundreds of thousands of dollars in fines. That was a deal I did. I was very upset about that. My resignation letter to Phil, I worded it carefully. I was an English major in college before I started working in the grocery business. And one of the things we use when we analyze poetry, we talk about the gap between appearance and reality when somebody wrote a poem. And to me, that's what I saw at Fleming, was this huge gap between the appearance that the CEO put out there and the reality of how the business was run every day. And I told Phil that I could no longer willingly suspend my disbelief in the way the company was being run. And that was true. I said, because you would sit around and look at each other and see the way you're doing business, just shake your head and say, I can't believe this, I can't believe it. And you have to willingly suspend that disbelief to operate in that environment, in that culture. Couldn't do that any longer. It's too obvious. I mean, the facts were too obvious. The business model was not working, at least not the way the CEO was describing it to Wall Street. That we're this big growth vehicle, we're going to be profitable. It was not. We were scraping for every penny. And another startup opportunity in New York became available. Once again, we could set our corporate buying office here in Chicago. So we got the team that put the Yes List stores, several of us back together, to open another chain of stores in the Northeast. And I was excited about that. Negotiated a fair salary, no bonuses, no stock options, it was a private company, it's one guy. The document that none of you ever want to see again and ever want to see your name on is this, it's my subpoena from the SEC to testify. So pass that around and make sure you never see one again. But the bottom line is that it's very easy to testify in front of the SEC. You tell them everything that happened, exactly why it happened, don't leave out any details, and it is what it is. Unfortunately, a lot of my testimony led to huge fines for the guy that worked right next door to me. His name's Al Abood. Here's the SEC exchange, what they charged each of those guys with. But I reported to Phil. Al Abood was a vice president, just like I was. He worked right next to me. If you don't live it and feel it, and you would never know. You can read about it, but it overtakes your whole being at some point when you're right in the middle of all of that, and you see it kind of crashing down. So, like I say, at the end, it can make you stronger, and I certainly learned a lot. They also wanted to know a lot about the CEO. The one thing I'm truly amazed about is that Mark Hansen, the CEO, he hasn't been charged with anything. But it's very difficult, and I have sympathy for the SEC as they go after like the Ken Lays of the world, or Bernie Ebbers from WorldCom, it's very difficult because these CEOs never send an email. They have assistants and they do everything in meetings, and it's all verbal. It's never taped, but the direction is completely clear. They walk into the meeting, they come out with their marching orders. Each senior person has to contribute a certain amount of money so he can hit the earnings that he's talking to Wall Street about. None of that is in writing, other than the notes that the guys take who are in the meeting. So I had to say, yes, when Phil came out at his meeting with Mark Hansen, this is what he came back to us with, that we need to make $30 million here to hit the number. What you really judged on is what you do and not what you say, which is right in some ways, but for a CEO who never does anything himself, he didn't sign any documents except Sarbanes-Oxley. When Sarbanes-Oxley came out, we were all, and it's an interesting sidelight, we were like, is he going to sign it? Is he going to sign it and say, yes, I believe all this information is 100% accurate, and he did. He did sign it. And I always thought that that would come back to haunt him, to say that to the best of my knowledge, all these numbers are accurate, everything's justified, when he knew in his heart anyway that it wasn't accurate, most of it was manufactured. And it's so interesting, when I used to hear Ken Lay, who would just insist on his innocence, you know, and just think, you know, what we did wasn't wrong. Yes, we did all of that. Yes, we created these subsidiaries and put the debt all over there, but that wasn't wrong. It wasn't wrong. It's like they convinced themselves that what they're doing is right. When I listen to some and read some of the quotes that Mark gave to Wall Street, that, you know, the deductions that we have with vendors aren't out of line. It's in the Wall Street Journal article. It's not out of line with what the industry standards are. It's a certain percentage of sales. It's always like that with every wholesaler. They convince themselves that what they're doing is right, that it's okay, and that that's just the way of doing business. There's just some sort of a mental illness almost when it comes to that. And the CEOs get it sometimes. It was frightening to watch. But I walked away from big bonuses just doing what I did. Other guys that stayed, even a few months after I was there, I was 2 months away, I think, from like a full year's bonus, which for them, again, was too generous, almost 80% of the salary. I didn't want it. I mean, who would want that? So I wasn't going to stay long. And I would have continued to do what I was supposed to do, which was to put together the best deals for the company that I could. How they were accounted for, I did kind of mentally separate myself from that. I had to. I mean, all I could do is what I knew was right every day. Negotiate for the best quality products at the lowest price. Simple. That's what I'm there for. How you want to account for everything else, I just kind of washed my hands of it and said, take it from there and go. That's kind of the mode I was in right at the time I left, and I would have found something else at some point. That was not sustainable down there. The guy that had worked for Fleming for probably 27 years was a merchandise manager there, and he stayed right till the end. And you know, it was horrible for him and his family, knowing that this 27-year career he had, and probably his retirement, you know, account with the company, was all in jeopardy at that point. I mean, his wife actually had some mental problems, and she committed suicide the day they went bankrupt. It was really, really horrible. There are personal tragedies involved when things like this go on.
Okay, let's see here. Let me get out of this thing. Yeah, there we go. Excuse me. Okay, so anyway, so that yeah, that was the Anthony video. Go through more questions. Any question on that? It's a very interesting case. I mean, not just because of, you know, I know Anthony, but he had this company, 100-year-old company, profitable, huge, you know, one of the biggest ones in the United States, and it literally went bankrupt because of what one person, the CEO, told Wall Street as far as what their earnings were going to be 1 year. And it didn't even last a year after that. You know, this isn't like it, you know, this isn't like, oh, 5 years later, it finally ran out of steam or something. After they cooked the books for the 1 year, it didn't last 9 months. They were bankrupt by October of 2023. So 2022 is when they cooked the books, and then 2023 they were out of business by October. Ran out of cash. That's how most companies go. So here you have this profitable, huge, old company that literally went bankrupt within 9 months of this fraudulent thing. And by the way, if you're wondering why did these people go to jail, most of them took plea deals. The SEC was actually trying to get the Mark Hansen And so these guys all took deals, where they would agree to these fines to testify what they heard and all that kind of stuff. But the SEC still never charged Mark Anthony. He's never been charged with anything. Um, and probably because of lack of, there's no direct, it's all hearsay. There's no direct connection to him. But by the way, the one thing that he was talking about, that they had this happened at PetSmart and Sam's Club. He did exactly the same thing at those two stores, and almost put both of those out of business. PetSmart was this fast growing company. He stopped paying the vendors. They stopped shipping stuff. You had this booming company that all of a sudden had empty shelves, and I know now we see empty shelves because of COVID and all that. But back then, you never saw empty shelves, and you had empty shelves. People coming in looking to buy stuff. Hey, I got some money I want to give you, and there's empty shelves because he won't pay the vendors, and and so PetSmart got rid of him. For however he got into Sam's Club, did the same thing at Sam's Club. Just stop paying the vendors. They stopped shipping. Again, you had this big, growing, booming company that all of a sudden had empty shelves. Had people coming in wanting to give them money, and he couldn't because he wasn't paying the vendors, and the vendors weren't shipping. So it was one of those things that happened. And by the way, I think he lasted a little bit more than a year at PetSmart. I don't think he lasted a whole year at Sam's Club. And then he came into Fleming, and he did exactly the same thing. And if you're wondering, well, why did they, what was the deal with him? Why did he do that? When you cut costs like that and you show these big profits or whatever, and you stop paying people, the stock price would jump up, and he'd cash in stock options. He made tens of millions of dollars doing that. Even at those other, at the PetSmart and at Sam's Club, same thing. He made tens of millions of dollars in a very short period of time. He made tens of millions of dollars in Fleming. The stock price of Fleming jumped from 11 to $26. I think even a little more than that. But anyway, and he sold off the options and made tons of millions of dollars doing it. And it is kind of it's a very strange, interesting case. Mark Fleming has, to my knowledge, never ran anything after that. That was like the last straw. But anyways, kind of an interesting case. And there is something we're going to do today when we look at materiality that has to do with management cooking the book so they get bonuses is part of the things that one of the things that we look at. So anyway, you can go ahead and turn that in. Let's see. Well, hey, I'll tell you, any questions on any of these? Do you guys think you got them? Oh, by the way, if you're wondering, Anthony was never charged, and he was never charged because he couldn't get that he didn't get that agreement signed, and which he thought was a complete failure of his, that he couldn't get this thing signed that says that, we can book this as a rebate. Luckiest thing that ever happened to him. Because he couldn't get it signed, he wasn't going to be charged. And anyway, we went into the SEC and he told them, they said, well, I tried to, but and they said, yeah, we know that already. We got that through the emails and all this other stuff and so, they just, they trusted him, and he just went and told them everything. And but yeah, talk about dumb luck. And again, he wasn't, he's never had a business class in his life, but, you know, it can catch people. All right. Any question on that? Okay, so we can turn that in. Let's go ahead and we can still, before break, let's get in one of the, I want to finish the sampling one. I think we can do the sample size one. So let's go ahead and jump into the sampling, the monetary unit. This some people usually do pretty well on. Okay. So what I'm going to do here is kind of fill in the numbers we know, and then we'll go get the numbers from the table that we need. Book value. Oops. Tolerable misstatement. And by the way, this is whatever is material for that account. And we'll talk about that later on today, actually. So they'll allow up to 30,000 to be this, whatever this account is. I don't give an account on here, what account it is, that probably doesn't matter. But anyway, this is the material, what we think the material misstatement is. We would allow for this account, whatever it is, so if this is inventory or whatever. Excuse me. Expected misstatement is, it could be what it was misstated by in the past or something like that. It could be past, um, could be an estimate. For a lot of companies that we use, they use this for, it'll be zero. It's very good for companies that don't have they generally don't have problems with their whatever it is you're looking at. They could, but they don't. So that's one of those things. And okay, so let's go ahead. So 1200 is what we think could be off by. Okay, and now we got to go grab some factors, and we're going to do this at 10%. Be careful on the test. If people do miss this one, they miss it because of this. So we're looking for 10%. Okay, so reliability factor at 0. Reliability factor at 0 is, and 10% is that. Oh, we can make these bigger. And our expansion factor is actually only one row, so you can't really goof this one up, even if you tried. 1.5. You shouldn't say that because a lot of times what people will do is they won't look at this is important to know what level you're at. So this is like at 90%. You're gonna say that, you want to be 90% sure or whatever. Okay. Time for calculator. Hey, where's my calculator? I'm gonna do something. I'm gonna add a row in here. Oof. Maybe I can't. Connected. These are all connected. All right. I'll do it. I'll do it up here, I guess. Oh, I know. I'll do it here. Sample size. All right. So the top is 500 times 2.31. Oh, I guess I can do it here. I'm sorry. Divided by, oh wait, I can't do it here. I'm being silly. Divided by the denominator. Probably easiest to do the 1200 times 1.5 first and then subtract it from the 30,000. $28,200. 41. You keep doing that. Okay. 500,000 divided by 41 equals 12,195. I'm gonna round off the nearest dollar. 12,195. Okay, so let's go ahead and stop here and we'll come back and finish this one. C54, 704. I'll see 705, I guess. Took me too long to write this. Okay. Okay. Let's go to the most difficult one. Uh, Metro unit sampling table. There's the last page of this handout. They're also up here. I should probably take them off the end of the handout. Anyway. Okay. Make sure you pay attention to this. It's going to make a difference later on. Book value 400,000. Okay. By far, the most missed ones we have are these. Okay, so there is only one here that is kind of what we'd expect. The first one here is what I would call well-behaved. The audit value is less than the book value, so this is an overstatement. This is what it's meant to detect. And the book value is less than the interval. So this is what I would call a well-behaved one. So we're going to divide it and kind of like the ratio analysis, the differential. Give me 1 second. I got to grab a phone. Okay, I'm back. Uh, so 200 divided by 250 times 5,000. 200. Okay, so the projected value of this one is 4,000. So projected misstatement would be 1,000. And we might as well just do it now, get it done with. Is it included in the incremental allowance? Yes. It's including incremental allowance. Incremental allowance means there could be more things wrong with it. So notice that this is, the book value is only 250 of the interval. So there could be more things wrong with it. And the idea being that if there are errors, if there are misstatements, two things come into play. First of all, it means there could be more because there's an example of one happening. And second of all, the dollar amount makes a difference. The larger the misstatement, the less sure you are of the numbers of the whether this thing is materially misstated or not. So there's two things that happen, and that's when it goes in the incremental allowance. First of all, is there a possibility that there could be more things wrong? And the amount of it makes a difference. Something that's misstated by $10 is different than something that's misstated by $10,000. Okay, what do we do with this one? Anyone?
Aren't you supposed to use the actual book value?
Well, for this one we will. This one is actually an understatement. So
Oh,
this
so you ignore it.
exactly. Yep. But we are going to use, you just said we're going to do that for the last one now. Wait, what did I do here? Hmm, doing stupid things here. Okay, so this will be an understatement. So we're going to ignore it, which, oops, which as an auditor and just as an accountant in general, it's one of those things, kind of seems wrong, but breaking misstatement is zero. It's not supposed to catch these things. And if it does, we say, well, let's just ignore it. So is this included? No, but it really wouldn't matter anyways, because if you multiplied zero times anything, it's going to be zero. So it wouldn't have any impact, even if you did try to use it. So understatement, we ignore it. Now this one, just like you said, this one is different in that it covers the entire interval. And we'll make that turquoise. So this covers the entire interval. So this leads us to a couple things. First of all, we're going to use the actual misstatement because it's covered the whole thing. We're going to say, okay, we're going to go to the actual misstatement. So the actual misstatement will be uh, 5,000. Oops. Minus 4,500 equals 1,300. Is that right? Yeah. And we'll make that, how about yellow? So we're going to use the actual misstatement of 1,300. Now, here's the weird thing about this one. So it covers the entire interval. Now, what they're actually saying here is that, look, there couldn't be anything wrong with this in this interval. This covers the entire thing. This may even actually cover two intervals. It's possible it spans two of them, but regardless, there's nothing else that could be wrong in that one. So we do not put it in the incremental allowance. We're only going to have one for the incremental allowance. So even though this is a projected misstatement, it is not, this one couldn't get any worse. It's as bad as it's going to get. And so all these together will give us this, which I should have lined up. 1,000 was there, so 2,300. Oops. And this is our best estimate as far as what it's off by. And I just want to talk about one more thing here, and just in general, and that is that not all misstatements are the same. I know it sounds strange, but as far as quality, and that actual misstatements carry a little bit more weight than the projected ones. And it's that way because they're not an, the projected ones are an estimate. We estimate that it's going to be off by whatever. We're projecting it over the population. Whereas actual ones are just actual. Those are that is exactly what it's misstated by, and you can actually point to it and say this account is. So getting back to our problem here, this 1300 is actually considered a more accurate number than this 1000 because this is an actual amount that it's misstated by. And you could go tell them, by the way, this account, what are these? Accounts receivable. So you can actually go tell them, look, this account's receivable, you have 1300 too much in it. You're gonna have to restate that because, um, this is what the people actually owe is 4,500. So this is an actual number for an actual account. It carries more weight than this, which is projected. In this one, you really don't know. This is off by $50, but we're projecting that it's off by 1,000. So you can't point, other than this $50 worth of actual misstatement, you can't really point to any accounts in this other 5,000 and say, oh, by the way, the other 950,000 is, this account or that account or whatever. It's a projection. Okay, basic precision. Sampling interval, which is what, 5,000? Times a reliability factor at 0. You can either go to this one up here or this one down here. Oh, wait, I need to get the risk of incorrect acceptance is 10. That's important. So we'll come down here. $2.31. So this will give us our basic precision. Yeah. And this basic precision says, okay, even if nothing was wrong, you didn't find any problems, it still can be misstated. Even if this was 0, it still could be misstated because this is a sample. I got 11,550. Oops. Okay, I'll insert a line. So if there were no errors, we would still have this. So no matter what we would do, as far as testing, we would know that right when we started that it's going to be the upper limit is going to be 11,550 less than whatever the 400,000. Okay, calculate. This is the odd one. All right. So let's see. We're at 10%. Let's go down here. Okay. Oh, we're at 10%. Okay. So what we're going to do is, nope, not that. Make it blue. So we're going to take the difference between 3.89 and 3.31. Let's just put it in. Okay. So at one overstatement of one is 3.89. I'm just going to do these separately. Minus the overstatement is 0. Minus 1, very important. Comes up with some number. 58? 0.58, I should say. And our largest misstatement first, and this goes up here. There's only one in our incremental allowance. This is our largest. It's actually the only one in this case, but it, by definition, it's also the largest. And this one is not included. So this one will not be in the incremental allowance. So this incremental allowance, wish I had more colors to do in here. So incremental allowance. So the largest is, it's actually the only one we have. So this would be 1,000. $580. Wait a minute. That looks funny. Oh well. And then calculating the upper limit. I'm just going to copy these down just to get them close. You don't have to do this. All these three together will be the upper limit. $14,430. Oops. Let's try it again. And so this would be our upper limit. So this at 10% would be what we think that this could be off by. It's our best estimate as far as what it could possibly be off by at the 90% level. Incorrect exam is 10%, so we're looking at the other 90%. So we're 90% sure of this. No, I got it. So, okay. I'll do it. That's fine. Mm-hmm. 80% sure. It's not exactly a statistic term, but we're 90% sure that this is the upper limit is 14,430. Any questions? Okay. So that can be saved, and I will have an exam coming out tonight. They're pretty much done. So probably within an hour of the end of class. But let's go to the chapter 6. Well, oops, let's get rid of this. Where's chapter 6? Blah, blah, blah. So chapter 6, we're now going into materiality, probably one of the more somewhat misunderstood concepts. So this is page 6. And we have two types of materiality. We have quantitative and qualitative. Quantitative is usually when people think of these are dollar amounts. What dollar amount is it? Oops. Um, so the dollar amount of the misstatement, this is kind of what we're looking at for this one. 100,000, 200 million, whatever it is. The materiality, what is it to a reasonable person? And there is no reasonable person in the world. It's just a kind of legal term of what would a reasonable person, what would they think is material? What would make a difference to them? You're gonna have people that say it shouldn't be off by even a penny, and then you're gonna have people that are reasonable who might say, okay, if it's off by 1% or 2% or whatever, it's fine. And by the way, the fact of the matter is that if you look at our accounting methods, you know, you look at like a piece of equipment, okay, we were depreciating it over 6 years. We don't know it's going to be like 6 years. It could be last for 8 years, it could last for four, it could last, and there's all kinds of estimates and stuff in accounting. And so even if it was down to the penny, it would still not be, most likely exactly what the actual income should be because we don't, how long is the piece of equipment going to last? How many people are going to be able to pay their bill? We don't know it down to the penny, and it would be a complete oddball if we ever did come up, with those to be 100% accurate. Okay, so there are some things though that we do, and every CPA firm will usually have their own. benchmarks, what they believe is a material amount. And so they come up with percentages usually. So it's a percentage of income, percentage of assets, sales, whatever. They can use more than one. It is possible to use more than one and get kind of an average. You could use more than one and use the higher or the lower of them. Um, different places will have different ones. And again, this is all judgment. Which one do you use is a judgment. Are we going to use the income before taxes? That's a judgment call. We use revenues. That's a judgment call. So this is all judgment. And that's one of the weird things about materiality. People think that it's, oh, because it's a solid dollar amount, there's no judgment involved. Yes, there is. There's judgment involved because which one you pick and which decimals, which percentages you choose is going to be judgment. Okay, so how does this work? Well, you'll notice something here, and that is these generally have ranges of amounts. Equity doesn't, but most just on this table. And by the way, these are not necessarily, I can't remember where I got this. I mean, this might be from the book. I can't remember. But these are not necessarily what everybody uses. I've actually seen what different companies use. I've had students that have actually ended up working for different CPA firms, and it's kind of funny. These are what we use for materiality. So like if it's the percentage that they use, if it's between $90 million in sales and 200 million, they use this percentage, and there's all kinds of tables that those are any CPA firm, can come up with those, and they'll come up with their own that they think mitigates that. It says, okay, this is what we can use for material, we should use for materiality. All right, so let's take a look here, though. You notice that there's a range. I think we're going to use the first one here. And the percentage allowed is inverse to the client size. In other words, the smaller number will go with the biggest companies. The biggest number will go with the smallest companies. So it's sort of like this. This will be the big companies, the big clients. And this over here will be the small. Now, medium-sized companies will be somewhere in the middle. Okay, so let's come down here. So we're going to use the income before earnings and taxes. We're going to use one we just looked at. That one right there. Bold everything. So company A, they have 150,000 of income. And we're looking at this first one here. So are they going to use, well, you tell me, what number do you think they're going to use? Are they use the 5%, the 10%, or something in between? Anyone? Is this a big company or a small company?
Big company?
I didn't make a small one. So what we're going to do is we're going to use the 10%. Oh, well, they're going to use the larger of the percentages, yeah. So this will be, we're going to use 10%. So this will be 150,000. Times, and we're going to use a larger number, 10%, or just 0.10. That looks confusing. I'm going to take that out. So we're going to allow them up to 15,000 to be have as far as what they could be their books could be misstated by. I'll make it green. So this would be their materiality, 15,000. And again, they're a small company. We're using the larger amounts, and I'll explain why in a second. All right, let's go to this one, Company B. Now this is a, let's say, middle-sized company. So we need to use a percentage somewhere in the middle. So who wants to throw out, there's no right or wrong to this, by the way. Who wants to throw out a number from right in the middle that we're going to use for this middle-sized company? Oops. Anyone? What percentage should we use? Again, there's no right or, as long as it's between 5 and 10%, there's no right or wrong. Anyone? I'll give you the choices. It could be 6, 7, 8, or 9. There is no right or wrong.
8.
Yay, that's it. That's the right one. 8. So we use 8%, or 0.08, 15 million. $4 million? I should be able to do that in my head. I'm sorry. Um, so we're gonna say it could be up by up to 4 million. So the overall materiality for the entire place could be up by 4 million. Okay. Company C, here's a giant company. Oops. Now this one is obviously big, so we're going to use 5%. So 150, no, 1 million, 1,500,000. Let me just write. Times 5% or 0.05. $75 million. Oh, wait a minute. Let's try that again. Okay. So these would be the materialities. And again, that table, we're going to use a range. And the range is going to be inverse whenever you're using these. Whenever you see a range, you use the inverse, that the larger percentage goes with the smaller companies. I know, I could do it like this. I know I'm going to make it more confusing. I'm going to make it more confusing, but it's just something I have to do. I have to make it more confusing. We'll say this. Okay, so big companies, small companies, and middle-sized ones are somewhere in the middle. So here's why. You say, well, why do we give this 10% for these small companies? Why don't we make them stay at 5% or whatever? A couple of reasons, but not the least of which is, a misstatement of 15,000 is not all that much. And quite honestly, you're worried about lawsuits. 15,000, it'd be unusual to get sued for that. Well, it is a little bit of a chunk, filing a lawsuit or something on a misstatement of 15,000, which may or may not even translate into actual dollars. It would be kind of unusual. So one of the reasons why we don't hold the smaller companies to those is that the numbers are smaller. And quite honestly, we're worried about lawsuits. Less likely with the smaller numbers that you have a lawsuit. A lawsuit might cost $20,000 to go through. You're going to spend $20,000 to recover 15,000. And at some point, trying to get a law firm to take it would be difficult. So smaller companies, we give them a little bit more leeway percentage wise because the dollars are just so much smaller. Now going down here, will people sue for $75 million? Yes, they will. So, people will definitely sue for this kind of money. When you start getting to large companies, the dollars are just so extreme. So think about this. You're not looking for anything, you're not looking for misstatements of less than 75 million. That's a pretty big number. Even for a company that has 1.5 billion of income, that's a pretty big number. So someone there's a $5 million misstatement here or there. It's not material. I just found a $10 million error. Yep. All right. Don't write it down in the work papers because I don't want to have to clear it. Well, you'd write it down. You just wouldn't put it in as a correction, an adjusting entry. Okay. So performance materiality. Performance materiality has to come from the overall materiality. And what we're going to do is, the question is, okay, the overall materiality for the entire audit is 200 million, 200,000. Getting old and senile is tough. Anyway, so let's say that I'm doing, we're auditing these three accounts. Now, we don't want all three of those to be off by the overall materiality of 200,000, right? I mean, this is for the entire audit. So if I'm working on cash, it isn't, gee, for my account is, I'm not looking at things that are off by 200,000 and here and here. You could be off by millions by the time you get to the end of it. So how much of this do we put to each of accounts? And they call this, and I'm not even sure why they call it this, but performance material. I guess when you're performing the audit of cash, performing the audit of accounts receivable, or performing inventory. So they call it performance materiality. And what we're going to do is take that 200,000 and we're going to split it up. Some of it's going to go to cash. Some of it's going to go to accounts receivable, and some of it's going to go to, and you would do this for, all the accounts that you think you're going to run into trouble with. Cash, by the way, for small to mid-sized companies, cash is often audited at 100%. In other words, you put in zero for this. But let's say we split it up. Let's say I'm going to put in, and I'm just making this number up. It has to be less than 200,000, but I'm going to say cash, we want to make sure that that's within, say, 5,000. Again, for a lot of times, small, mid-sized companies, it'll be zero. and and here's why. Yeah, cash is a weird account. Well, it's not a weird account. It's a very important account. But cash is a couple of things about cash. Oftentimes, you can audit cash to 100%. If they have 10 different bank accounts, you can get the bank accounts for 10 bank accounts. The bank statements. So a lot of times you can audit cash to 100% in many companies. So you do. Another thing though about cash is very important, and so almost all transactions go through cash eventually. If you make a sale, even if the sale is cash, obviously it goes through the cash account. But if the sale's on account, okay, the accounts receivable eventually gets paid. That goes through cash. So you can verify accounts receivable sales by it going through cash. Almost everything goes through cash eventually. You buy a building, you get a mortgage. Okay, well, you pay off the mortgage. What do you pay it off with? Cash. That establishes there's a mortgage. Eventually, the mortgage gets paid off. When it gets paid off, that's cash. You can verify virtually everything that's on it. It's You almost really have to be creative to find something that doesn't go through cash. I guess if you traded land for some stock in the company, that would be a non-cash. But it's difficult to almost think about like what transactions don't go through cash. Almost all of them do. So cash is very important, and you might audit it to zero because you want to tie in all these other accounts, and those accounts themselves will also have some performance materiality hits to them. So it's not unusual to have this at zero. But let's go on. Accounts receivable. Okay, accounts receivable maybe is a little bit trickier. We got to, send out our confirmations and you get stuff back and you're not 100% sure on these accounts. So again, I'm just going to make up a number and say, let's say 40,000. So of the 200,000, 5,000 is going to cash, 40,000 is going to accounts receivable. So how much are we going to give to inventory? No answer yet. I got to look. I think I know what it is. You can go ahead and answer. How much is going to go to inventory? Yeah, if these were the only three accounts that we were giving materiality to. How much would go to inventory?
Would it be the remaining
Yep.
of the 200,000?
Yeah, 100 and I think it's 155, isn't it? You may
Yes.
wanna check that, yeah. So we will split this up, and this is called performance materiality. So if we're doing an audit, if we're doing a sample, this will be our tolerable misstatement. Do I still have that up? I don't think I do. Yeah, I closed it. So this tolerable misstatement, this is what we're talking about. This would be the same as a performance materiality. So we would plug that in. Was that the same number? No, it's 30,000. That would have been cool if it was. Anyway, so yeah, so that is the quantity. So this is all quantitative dollar amounts. Qualitative. This one is much more. It's even more of a judgment call, but there are some things that even though dollar wise they are, oh, I don't need to underline that. Even though dollar wise they're not material, the nature of those items might make it material. And things that reflect on, say, the integrity of management. So a fraud, let's say there's a low dollar fraud. Okay, well, it's it's probably not material if it's somebody, a supervisor on a loading dock somewhere is doing a fraud. Somebody has no connection to the financial statements. We probably ignore it. I mean, if we found it, we'd tell the company about it, our client about it, but we're not going to certainly not going to do anything in the financial statements. So you get someone on a loading dock and they're stealing some stuff off the loading dock, and okay, you find it, but it's not it. Now you take that same situation, a low dollar fraud. Let's say there's someone like the chief financial officer is basically stealing money through his or her company business account, business expenses. I think I may have told. I don't know if I told you that my first audit assignment was for um, expense reports. And unfortunately, two people got fired, which was not. It's not as a happy feeling as you might think when you find fraud. Oh crap. Um, but anyway, I found people that were stealing about $5,000-6,000 a year. But now, if that's somebody high up in the company, that leads to questions about the integrity of management. And again, the ACCT rules, integrity of management is the big. They'll tell you that's the biggest thing. So if it does reflect on integrity of management, it's a problem. Violation of contracts. Common one is violation of bank agreements. So a lot of times banks will make sure that you only do banking through them. They'll say you can't get loans from anybody except us. We'll give you the loans, we'll have your bank accounts and all that kind of stuff, but you can only deal with us. It's an exclusive right. And what they don't want you to do is go out and get a whole bunch of loans from different banks on the same property and the same business, and then if things go wrong, you get 10 people with their hand out trying to figure out who gets what. So they'll have these loan agreements. So sometimes those might get violated. Even if it's a small amount, they get a small loan from somebody. If it violates the banking contract, it's material. Reversing a trend. Maybe you have an increase in sales every year and you're just going to miss it. So you cook the books for just a little bit so that you don't miss out on sales increasing every year. If it reverses a trend, even though it's a small amount, it could be material. Changing losses into income. Give you a heads up, we're going to have one of these in a few short minutes here. And going to the Anthony case. uh, increases management's bonuses. So even though it might be a small amount, maybe they just missed their bonus, but they decide, okay, let's cook the books for a little bit so we can make our bonuses. Well, a low dollar amount might, even though it's not material as far as the dollar amount, if it's made to enrich somebody fraudulently, that is a material. So these are some. There's numerous ones it could be, but these are probably the most useful, the most usual ones. Yeah. So again, these could be very low dollars. They could be, literally in the thousands of dollars rather than the millions or whatever, and still be material. Okay. I think we may have talked about this already. Audit documentation. Who owns the audit documentation? The auditors own it. It's used for planning the audit. Support for the audit report, and actually I should say um, probably more accurate to say the audit opinion in the audit report. You know, you come up with it as a clean opinion or a qualified or adverse or whatever. Your audit documentation, the work papers will be that. And also working paper review. These your audit work papers will be reviewed by people. It varies, but certainly people within the CPA firm will review it. Seniors, managers, partners. You could also have other partners do it. You could also have people on the outside that will come in and review your work papers. And by the way, it is possible to have outsiders come and review the work papers. People say, well, wait a minute. You can't do that because you have this fiduciary duty of independence. Yeah, not independence, fiduciary duty of confidentiality. You know, you can't show your whatever. You actually can if it is a review, if it's a review necessary for quality, or if it's a review of a professional organization or of a state, you know, looking at what you do, then it's allowed. But those people that actually do those reviews, they are also held to that same confidentiality as the auditors themselves. So if I'm reviewing somebody's, you know, an audit and I'm not on the audit, um, I am held to that same fiduciary standards of not disclosing any of the information or using it. Okay. I don't know if we needed to go through this. This is one of those things. If you're taking the CPA exam, you're going to memorize these or kind of memorize them, get familiar with them. But permanent file are for things you're gonna need every year. The organization charts, things like that, you're going to update that every year. Um, Big contracts that go from year to year, all that kind of stuff. The current file is just for the current things, the current numbers on the current financial statements and all that. So permanent file, things that are used every year. Current file, stuff that's specific to the current year you're working on. Let's jump to the problem. You're going to get one of these on the exam. Okay. During the audit, the current year, the esteemed members, an understatement of $25,000 in expense account. The following data relates to the audit. So here's their income statement. And this is off of the balance sheet. I should put that there. Oops. Yeah. This is their income statement. All right. Tolerable misstatement for expenses is $35,000. So this is the performance materiality. So it's up by 25,000. Performance materiality says 35,000. So these are gonna be open information. Is the understate is a change this? Change this to 25,000. I'm sorry. Change both of those to 25,000. not 50,000. That's a cut and paste error. Or actually not a cut and paste error. It should have been a cut and paste error. They should have cut and pasted 25,000 in. So make sure you change that. 25,000. That's what the misstatement is. All right. So is the 25,000 understatement? A quantitative or a quantitative material misstatement? So they're understating their expenses by 25,000. Quantitatively, dollar wise, is that a problem? Let me get rid of this for a second. So this $25,000 and our performance materiality is 35,000. So is this material dollar wise? Anyone? You know what? We're running over. I'll just go ahead and do it. No, it's not material. The performance materiality, that's about materiality. Maybe I'll put, you know what? Let me put performance in. Oops, 35. Okay, so quantitatively, this is fine. So this is for the dollar amounts. Okay, nature of the misstatement. Now, notice what would happen up here. Let's see what this would be if we had now notice our expenses would be $25,000 higher. Oops. Our net income would now be a let me tap it over a little, I think. Okay. So we actually have a net loss of $15,000. So notice that this misstatement changed a net loss into, a net income or a net gain. So this is material. This is qualitatively material. Because it changes the loss into income. Yes. So this one is no. This one is yes. So this would be a misstatement. This would be materially misstated. It's not a quantitative, it's a qualitative misstatement. Because it changes a loss into income. You're gonna get one of those in the test. Okay. Any question on that? I'm gonna take a screenshot of that. All right, we went over this week. I'll make it up to you next week. But so actually we can turn all three of these in. Wait a minute. Yeah, you say all three of what? Well, of these.